Many people are stressed out and upset because they're afraid that they're going to lose their home very soon, and they don't understand the foreclosure timeline and the process in California. So let me explain it clearly and simply so that you don't have any questions as to whether or not the bank can foreclose on you next month or what kind of time frame you have left in your home. Banks must formally file 2 public notices with the county. The first notice can technically take place after 31 days of missed payments. So if my payment's due on the 1st, and by the 1st of the next month I haven't made my payment, therefore I'm in default, they can technically file a notice of default on that date. However, banks know that most homeowners will not default in their home just 1 month and then go all the way to foreclosure, but most of them will recover from that, and so they don't want to trigger that notice of default until after 2 or 3 months missed payments, when there's a higher percentage of those actually going all the way to foreclosure. Because the bank knows if you've missed 3 payments in a row, most likely 80% of those homes are actually going to go all the way to foreclosure. So most often in California, we see the notice of default, which is the first public notice, is filed after 3 to 6 months of missed payments. And in some cases, it can be even a year or longer, depending on the servicer and the lender, and if the file's actually fallen through the cracks. The second notice is a minimum of 90 days from the first notice. So first is the notice of default, and the soonest that the next notice, which is called the notice of trustee sale, can be actually filed with the county is 90 days from the date of the first notice. And in this notice, the notice of trustee sale, the lender will give you 20 days notice of the actual auction or sale date. So basically in California, the fastest that a foreclosure could take place is in 141 days. But on average, and what's typical in California, is 8 to 9 months or even longer. The foreclosing lender, which is usually the first mortgage holder, if there's 2 loans in your property, it's usually the first lender who's actually proceeding with the foreclosure process. They will often postpone the auction sale date if you're working on a short sale or loan modification. The reason they do this is because the short sale makes them more money. And they know that the last minute loan mod and short sale has a low success rate. So if you do a loan modification or a short sale a couple weeks before the actual auction date, in many cases they'll reject your offer to do a short sale or loan modification because they only view it as a stall tactic. And in other cases we've seen where someone tries a loan mod for months and months, and by the end of the loan mod they get denied, and they're only a couple weeks from the foreclosure sale date, and the bank actually forecloses instead of giving them the chance to do a short sale. So in some cases, doing a loan modification can prohibit you or limit your ability to do a short sale when you're getting close to the foreclosure sale date.